I find myself in the classic situation that I assume the majority of traders are familiar with, having to manage a loss. Today, I opened a trade convinced of a specific direction, and after a moment, the market trend turned against me. So now, I must face a loss. What are the possible solutions to resolve this losing trade? In other words, what choices should I make to exit this unpleasant situation without incurring a loss? I invite you to reflect so that you can focus on the solution. In essence, what would you do if you were in my situation? You open a trade and find it in a loss. How do you handle it? I assume that you already have a more or less clear idea of how to intervene to avoid incurring a loss. Personally, I believe that almost everyone listening to me would exclude closing the trade. We know well how crucial it is to cut losses. However, it is a choice that almost no one applies. Why? Because closing a trade is equivalent to losing money. Closing a trade at a loss means reducing the account balance compared to the initial deposit, and this is detrimental to our mental well-being. It imposes an additional workload and significant stress on our minds, which should ideally be calmly focused on the market trend. Moreover, closing at a loss would require further effort in study and analysis to redefine our strategic plans. The reduction of available funds makes it challenging not only to generate profits, but also to recover losses. Consequently, the decrease in funds implies a necessary reduction in risk, accompanied by a lowering of engagement levels. This implies that any profits, obtained through a fortunate consecutive series of orders closed in profit, would significantly extend the capital recovery times. Without considering the time spent on researching an entry model that has proven unreliable, the uncertainty generated by the event could lead to unmanageable and catastrophic scenarios. For example, closing a losing trade at a time when the market, perhaps due to unexpected macroeconomic data, has deviated from the trend that we had correctly anticipated. How many times have we closed at a loss, only to witness a recovery by the market moments later, up to the prices where we were exposed? In short, unpleasant situations that cast doubt on our market preparation. However, we cannot even consider holding the entire counter trend as long as we are unable to determine the extent to which the market will extend. This is because if we have made a mistake in our operational choice, we cannot be certain of our assessments. In other words, we cannot be sure that the market will not continue its contrary trend. In a short time, we could incur additional losses, and the current prices, in a situation of market adversity, could prove more favorable to consider closing our exposure. Do you understand how many uncertainties are hidden behind an adverse trade? Some, however, might avoid all these considerations and simply open another trade in the same direction with the sole aim of raising their average entry price. But let's also consider this case. Is it worth raising the break-even point? Opening an additional trade in the same direction at a higher price would undoubtedly lower the level at which we are exposed. So, we would gain an advantage because, from the current quote to our break-even level, the market would require fewer pips to exit the adverse scenario compared to the previous situation where we remained exposed only with the first trade. However, this comes at a very high cost. The first rule of a good manager is not to invest further money in a bad deal. And it seems that this is indeed a bad deal. It's evident the market trend is causing financial losses. Adding more capital in an unfavorable situation could exacerbate the losses, interfering with my daily plans. The additional stress from the constant need to monitor the market's performance could distract me from my daily commitments. Alternatively, I could consider doubling the leverage. This would allow me to get even closer to my average entry level. But given the situation, if the market's counter trend persists, I would find myself exponentially increasing the losses. In essence, considering the time already lost and the risk of losing additional funds, is it really worthwhile to take this path? Some might consider the option of opening another trade opposite to the previous one, attempting to offset the loss of the first operation with the profit from the second. However, this strategy raises a significant doubt. Which of the two operations should be maintained, and which should be closed? The risk of mistakenly closing the wrong position could further worsen the situation. In essence, even if I decided to close the operation at a profit, the loss accumulated from the previous losing operation could negate the newly gained profit. This would make the closure of the last trade seem like a futile effort, characterized only by stress and without a concrete impact on my funds. I would find myself constantly reassessing my plans and waiting hopefully for a market recovery, considering the risk of a margin call due to the reduction of available margin in a counter trend. Understand how ineffective these strategies are? All these efforts, only to risk losing time and additional money. Working hard, balancing stress with optimism, only to see profits disappear at the end of the day in the best-case scenario, and in the worst case, even losing the funds. If an operation subject to rollover costs is prolonged, one might notice that these costs would qualify these strategies as unsustainable trading plans. In this way, the responsibility for the losses would be attributed to the entry rules and strategies considered ineffective and obsolete. When facing the market, it's essential to have tools that allow for the prompt recovery of any losses. This need arises from the awareness that, while not infallible, it's still possible to refine one's strategies. However, let's consider the hypothesis of encountering losses in our business. In such a case, how should we react? It's crucial to possess reliable strategies that allow for exiting loss situations without further damage. The definition of stop-loss, portfolio diversification, and constant strategy revision in response to market conditions are just a few key practices in this context. When dealing with an adverse market situation, we not only experience anxiety and stress, risking financial losses, but we are also missing the opportunity to make profits. Let's never underestimate this concept. In addition to financial loss, there is also the missed possibility of making profits. It's challenging to determine which of the two situations is worse in terms of overall impact. So, as a good negotiator, it is necessary to intervene immediately to avoid wasting time, opportunities, and money. I cannot exempt myself from this duty because I have capital tied up due to a bad deal, which is generating more of the same. Therefore, it is essential to equip ourselves with tools that can help us be prompt and wise in decisions that can make a difference in preserving and optimizing the capital we have. At the moment when volatility decreases and the market stabilizes in a price range far from our entry levels, the odds in our favor decrease. In other words, the market trend can either worsen our financial exposures or improve them. As managers, we cannot afford to give the market time to resolve adverse situations for us. This is because the market has its own timing. It waits for no one and has no hurry for anyone. It is up to us to optimize the timing to protect and enhance our financial positions. We need to realize that in similar adverse scenarios, we are losing time, money, and opportunities. When I opened that operation, the intention was to make a profit. I wanted to risk money because I wanted to earn. But due to an unexpected event, I am risking money. Part of my money is stuck, and therefore, I am unable to do it. In short, I am losing an opportunity to gain because I have tied up capital in a bad deal. So what would be the solution, considering that what was discussed previously not only involves the loss of time, but also compels us to invest more money in an uncertain situation that makes it difficult to exit and regain control of our affairs? I am in a deal that is not paying off. The rule would be to get out at the least possible cost. But I want to optimize even the time I have already lost, to exit quickly by investing in another deal that will allow me to exit immediately. This is because if I were to open additional trades with a doubling strategy, the market recovery time should also be considered, because the market will have to retrace the same price to where we were positioned. And this, in addition to costing money, takes time that we will never be able to quantify. And the market will always take twice as long to recover as it takes to cause losses. Timings that I currently cannot afford because the market can take a day, a week, or a month, and I cannot stop my trading activity due to this unforeseen circumstance, nor do I want to miss trading opportunities that I cannot exploit because I have capital tied up as collateral. So what would be the most obvious solution? First of all, does a solution exist? A strategy that allows us to recover time and money immediately? Yes, it exists. Do we have tools that will allow us to do this with total control in our strategic plans? Yes, they exist. And one of the tools that allows all this is found in jMath FX. It is the only exclusive tool that no trading platform has and can never have due to their structural limitations. Through this tool, which we will also see with examples, it will be possible to have greater control over our exposure, know in advance the outcome of our investments, and know the prices and exchange rates that will allow us to exit adverse situations with little money, little time, and few pips. In conclusion, the losses generated in trading activities are caused by a structural limitation on the concept through which common trading platforms are built, which is the time-price paradigm. This structure imposes a one-dimensional view of the market, while, from a mathematical point of view, the market has proven to be multidimensional, with an understanding possible only through a completely new and different concept, applicable only in the context of jMath FX. In other words, the market never corresponds to the graphical description provided by common trading platforms. However, we will not delve into these topics here, also because you will have the opportunity to explore them directly in the jMath FX Academy by consulting the published video content. And it is precisely through this mathematical peculiarity of the market that, from today, using one of the most exclusive and advanced tools in jMath FX, we can recover time, money, and opportunities from adverse market situations, gaining time and points that will allow an immediate increase in profits. In traditional trading platforms, in an unfavorable market context, options might be limited to strategies like gridding, averaging, or doubling, involving exponential risks whose solution is dictated by market-imposed timelines. In essence, these platforms lack tools that indicate effective escape routes from losing situations. So, what would be the solution that allows us to face adverse scenarios with complete serenity? In jMath FX, we have a very effective and important tool for our trading activity. In the platform, we observe an adverse scenario. So how could we resolve it? Let's go to Premium Tools,